All right, let's dive into a real head-scratcher today. We're looking at a technical analysis report for CleanSpark, a super volatile crypto mining stock. And trust me, this is a tricky one. The clues are pointing in completely opposite directions. So let's get our detective hats on and start cracking this case. So we've opened the case file, and at first glance, it looks pretty straightforward, right? A stock that's just been hammered, down 40% from its peak. But as you're about to see, the evidence is, well, it's all over the place. Our mission is to sift through all this conflicting data and figure out what's really going on behind these numbers. Every investigation has to start at the scene of the crime. And for us, that's the price chart for CleanSpark, ticker symbol CLSK. And wow, what a scene it is. We're talking about a steep, sudden, and pretty dramatic plunge. What's really shocking here is just how fast this all happened. I mean, look at this. On October 15th, the stock is flying high, over $23. Fast forward less than a month to November 11th, and it's crashed all the way down to $13.52. That is a brutal drop in a seriously short amount of time. And just to put a fine point on it, that's a 40.5% haircut from its peak. This one number tells you everything. We're not just talking about a bad couple of days here. We are investigating a major market event. Okay, so first things first in any investigation, you follow the most obvious trail. And in the world of stock analysis, that means looking at the big trend indicators. So where are all the signs pointing? Our first big piece of evidence comes from something called moving averages. Honestly, the best way to think about these is like footprints in the sand. They kind of smooth out all the chaotic day-to-day price swings and just show you the clear path the stock has been walking. And these footprints, they are telling a very clear story. The current price is way below its short, medium, and longer-term averages. I mean, being a staggering 22% below the 20-day average, that shows some incredibly intense recent selling pressure. This isn't just a hint of weakness, this is a bullhorn screaming that we're in a strong downtrend. And it's not just the moving averages either. You look at other classic trend-following tools and they're all singing the same sad song. The Arun oscillator, which measures trend strength, is strongly bearish. The MACD, a momentum gauge, is negative. The report even gives the stock an overall technical score of negative 38%. So this seems like an open and shut case, right? So the takeaway from this first part of our investigation is simple. All the main evidence, all the big flashing signs, they all confirm exactly what we saw on that price chart. The trail leads decisively downhill. But a good detective never stops at the obvious stuff. You always have to search for the hidden clues, for anything that might poke holes in the main story. So now it's time to dig a little deeper. And our first major counterclue comes from the Relative Strength Index, or the RSI. Think of this thing like a pressure gauge for the stock. It tells us if the buying or the selling has just gotten way too extreme, which could mean a reversal is just around the corner. And check this out. The report's RSI rating is 37.40. Now, what's crucial is that this analysis considers anything below 40 to be an oversold territory. And boom, this is our first real piece of contradictory evidence, a signal that maybe, just maybe, the panic selling was overdone. Building on that clue, we've got an even more sensitive momentum detector, the stochastic oscillator. This tool is designed for one thing, flagging extreme conditions. It tells us when the selling pressure might be completely and utterly exhausted. Now, this is a critical piece of evidence. The stochastic is reading just 14.53. The report considers anything below 20 to be extremely oversold. So that pressure gauge we talked about, it's not just low, it's practically on empty. This is a powerful clue that this downtrend might be running out of gas. So, this brings us to the heart of the conflict in our case. We have one set of very convincing evidence pointing to a continued freefall, and another set of clues suggesting a rebound is just waiting to happen. It's the classic showdown, bulls versus the bears. And you can see the conflict laid out right here. On one side, you have the powerful bearish case. The price is way below its averages, all the main trend indicators are flashing red. But then, on the other side, you have these compelling bullish clues. Both momentum gauges are screaming oversold, which suggests the selling is just exhausted. And this is the million-dollar question for any analyst, right? Do you trust the big, dominant trend? Or do you bet on these little contradictory clues that suggest that trend is on its last legs? What do you do? So after weighing all of this conflicting evidence, what's the final verdict from the analyst who wrote the report? Let's take a look at their conclusion. First, the analyst identifies the key battlegrounds on the chart. They see critical support. That's the line in the sand the bulls have to defend at 1365. If the price breaks below that, the downtrend is probably going to continue. The key resistance they need to break is 1427. A move above that could signal a real reversal. The stock's entire fate is probably going to be decided right in this tight little range. And here it is, the final recommendation, pulled directly from the report. The analyst is very clear. This is a high-risk trade. But they suggest considering a buy if the stock dips to that critical support level of 1365, and, this is key, with a very clear exit plan, a stop loss at $13. So, here's the bottom line. The analyst is saying, yes, the downtrend is powerful and very real. But they believe those clues from the oversold oscillators are just too strong to ignore. The final verdict isn't a prediction of a guaranteed win, but a suggestion of a calculated risk, a bet that all this extreme selling has created a short-term buying opportunity. And that's really where this technical report leaves us. It doesn't claim to predict the future, but what it does is provide a fascinating, high-risk playbook based on all this conflicting evidence. With the stage now set at that critical support level, the final question is still out there. Who's going to seize control of this thing? The bulls or the bears?